Hey there, future Warren Buffetts. Ever wondered how the Oracle of Omaha himself can glance at a balance sheet and instantly know if a company is a financial fortress or a house of cards? Well, you're in luck. In today's video, we're diving into Warren Buffett's top secret, okay, not so secret, 5 rules of thumb for analyzing balance sheets. And to spice things up, we're going to put these rules to the test using everyone's favorite burrito brand, Chipotle. But before we get started, I'm Brian Feraldi, your financial Jedi Master, here to turn you from a spreadsheet Padawan into a balance sheet boss. Ready? Let's do this. All right, first things first, what's a balance sheet? Imagine the balance sheet as the financial Tinder profile of a company. On one side, you've got everything it owns, its assets, swipe right on those. And on the other, everything it owes, its liabilities, swipe left, obviously. The catch? Assets always have to equal liabilities plus shareholders' equity, because like any good relationship, balance is key. This is why they call it a balance sheet. Mind-blowing, I know. Buffett's rule number 1, cash versus debt. Rule numero uno in Buffett's playbook, cash, debt. Simple, right? Warren likes his companies like he likes his burgers, full of cash and free of debt. You know, just like that extra cheese, only financially healthier. Let's break it down with Chipotle. Imagine Chipotle is a burrito-making, cash-generating machine with $1.42 billion in cash sitting in the bank. Pretty spicy. Now what about debt? Crickets chirping? Oh look, Chipotle has no debt. Nada. Zip. That's Buffett approved, ladies and gentlemen. Chipotle's already passing the test and we're just getting started. Buffett's rule number 2, debt to equity ratio. Next up, the debt to equity ratio. Now Warren doesn't want to see this number creep above 0.8. Anything higher and it's like getting a soggy burrito. You don't want it. Chipotle, however, clocks in with a debt-to-equity ratio of 1.2. Oof, that's a bit of a buzzkill. But wait, there's a twist. The debt here is mostly long-term leases, not actual borrowing. It's like renting an apartment, not taking out a mortgage. So, while some financial calculators might freak out, we're staying chill. Adjust for this, and Chipotle's looking pretty sharp. Warren might give a knowing nod on this one. Buffett's rule number 3, no preferred stock. On to rule number 3, no preferred stock. Warren Buffett has a very simple rule here. 0 means hero. Preferred stock is like the unnecessary guac at Chipotle. It's nice, but you don't really need it, and sometimes it's just better without. Check Chipotle's balance sheet and bingo, no preferred stock in sight. Chipotle is 3 for 3, folks. Buffett's rule number 4, retained earnings growth. Moving on to rule number 4, retained earnings growth. This is basically the company's piggy bank for reinvesting in itself. Warren loves to see this piggy bank getting fatter, especially when times are tough. Let's look at Chipotle. Even during the crazy times of 2020 and 2021, Chipotle kept growing those retained earnings like a champ. This burrito joint doesn't just survive, it thrives. So, another big check for Buffett's rulebook. Buffett's rule number 5, treasury stock. Last but not least, we have rule number 5, treasury stock. Warren wants to see a company buying back its own shares, kind of like doubling down on itself. And guess what? Chipotle has been on a buying spree, snapping up over $5 billion of its own stock. This shows that Chipotle's confidence in itself is as solid as its guacamole game. So, there you have it. Warren Buffett's 5 simple rules for analyzing a balance sheet, all passed by Chipotle, with a little extra seasoning of nuance. If you want to get a free cheat sheet with all of these rules, just hit the link in the description below. And hey, if this video helped you, why not give it a thumbs up? Better yet, subscribe and join the crew. because we're just getting started on this financial journey. Stay safe and stay informed.